Hey, good morning, everybody. It's Hammer from Originator Success. Welcome. It's Happy Monday, December 18th, 2023. And I'm here, of course, to talk to you about your mortgage market update, the daily live, the only place on the web where you guys get to be a part of the conversation. What are we going to talk about today? Today, we got some good stuff here. We're going to talk about what economic data is coming up this week, how that's going to affect mortgage rates. We're going to talk about the Fed and different Fed members pushing back. And I'll tell you what that means and how that's going to affect rates this week. And then we'll take a look at the charts and the graphs and the pretty pictures. And overall, we're just going to kind of figure out where do we think things are going to go with the holiday coming up, what generally happens to rates this time of year, and where do we go today. So welcome. Remember, you can join me live each and every day, 9:30 a.m. Eastern time. If you're here live, say good morning. Would love to speak to you. Would love to recognize you. If you're watching on the replay, do me a favor. Give me a hashtag replay in the comments. Let us know that you were here. Let Facebook or YouTube know that you were here. Don't forget to smash that like button, tag an LO friend, share us in a group. If you're on YouTube, go ahead and subscribe or give us a thumbs up. Let's go ahead and say hi to the live folks. We got Mallory Fotiadas here, Tom Deadmore. Good morning, y'all. If you're here live, go ahead and say good morning. Otherwise, let's jump into the good stuff. So rate sheets this morning should be a bit worse than Friday. I say a bit. It's just going to be a little bit in pricing. Mortgage bonds right now starting the day off. We're down about 10, 11 basis points to start the day. Nothing to get too excited about, but it does bring us a little bit lower than where we were on Friday. Friday when pricing came out, mortgage bonds were around 100.25 or 100.30. They were kind of rolling in and around there. We're a 100.13 right now. So we're down about 15 to 20 basis points from when pricing came out on Friday. That means rate sheets today will be a little bit worse. As far as how Friday finished out the day after we did the video, you can see here down in this bottom right-hand corner, this line chart shows us how Friday performed on the day. We had a bit of a hiccup early in the morning, but we did improve as pricing came out. Things were actually looking pretty good. Looking at that in perspective of a 5-day chart, you could see that we hit our best levels on Thursday. We're slightly worse than that on Friday. It was just a little bit lower here, as you can see. And on Friday itself, we had a little bit of a window here in the afternoon where mortgage bonds were losing ground. We did send out an alert. It looked like we were at risk of some reprices worse, especially on a Friday, but that did kind of pass and things settled down. As far as where we are at today we're starting the day a little bit lower than where we were when we first opened. Reprice risk on the day is low, though. We shouldn't see anything that will cause bonds to lose enough ground to create a lot of reprice risk. Should be a fairly quiet day. The outlook remains as it has been. I think we're kind of at the bottom for now. I think that rates have settled in, and I think this could be a good thing. We'll talk a little bit more about that in a minute, but overall, I think we are in a spot where things are starting to settle in. So let's go back and say hi to the rest of the live folks that said hello this morning. Denise, good morning. Ron Siegel, how are you, my friend? I hope your weekend went well. Rob Stewart, Kenny Rivard, hello. Mike Tebow, how's Michigan? Cold? Scott Minster, good morning, sir. Denise, thank you for tagging other originators and encouraging them to join. Appreciate that. And great to see all of you here. If you're here this morning, say good morning. Let me know that you're here and say hello. So anyway, as we go back to kind of the outlook, I think this is kind of it as far as where rates are going to be for right now. I've talked about this before, and I'll kind of show you again. So looking here, let's use Mortgage News Daily as the reference point. And rates, they're 6.64. The lowest we hit was 6.62. That was better than 6.82, which was obviously much better than anything in the sevens. Now, why do I think that we are settling in and this could be the bottom? Well, right now, when we take a look and see with the Fed is Fed futures markets are pricing in a 90% expectation that we will see the Fed continue to leave rates alone in January. So a rate cut's off the table, right? We've talked about that Fed pivot. However, it's unlikely as of right now that markets believe we will see a January rate cut. Now, this meeting is at the end of January. You'll notice it's January 31st. So it's actually about 6 weeks away. What would we have to do to see this improve? And that would improve mortgage rates. So in other words, if markets believe that the Fed is likely to start cutting rates in January, we would see mortgage rates improve on that news. It's very unlikely we get that, though. We would have to see a big miss in the labor market data that comes in on January 5th. We'd have to see the inflation data on January, I think it's 11th. come in better than expected. And all of this unlikely. Right now, when we take a look and see, markets believe that the Fed is going to cut rates starting in March. So there's only a 27% expectation right now that we're going to be at 5.25. The rest of it believe we're going to be lower than that. And as we look through the entire year, by the time we get to December, markets are pricing in that we're generally going to be at 3.75, which that would be 150 basis points. So markets currently pricing in 150 basis points. The Fed, with the dot plot last week, priced in 75. So 3 rate cuts, quarter point. Markets believing we're going to see as many as 6 rate cuts next year. And if we start to see pushback, which is what we're seeing from the Fed members, we're seeing pushback here. So what happens when we look at the Fed says, hey, we don't think that we're going to see that. The Fed's Goolsbee, which is the Chicago Fed president, says too early to declare victory over inflation. If we go ahead and look here, futures defy Fed caution. The exuberance from last week is showing few signs of fading on Monday, even after a string of U.S. officials tried to inject a degree of caution over the weekend. This weekend, Atlanta Fed President Raphael Bostic, who I believe will be a voting member in 2024, told Reuters he doesn't see cuts starting until the third quarter. That's a big difference from March. Now, we know that Raphael Bostic tends to be very hawkish here on this. And, it's very unlikely that he's correct that it'll take that long. But he is pushing back. Chicago Fed President Austin Goolsbee said it's an overstatement to consider rate cuts until officials are convinced inflation is on a path lower to its target. And then New York Fed President John Williams kicked off the pushback on Friday, a couple days ago, by saying it's too early to begin thinking about lowering borrowing costs. So here's the deal. All of this in originator speak, right? Let's take the jargon out of this. So what the Fed is looking for, this is the headline inflation numbers, and the Fed is looking for this to continue to trend down. You see it's kind of flattened out here, but really they're not worried about the headline. They're worried about the core, and this is the core. And when we look at the core, hold on, I didn't mean to click all these. Let's turn off that one. There we go. When we look at the core, you can see that core inflation is definitely trending lower, and that's good, but they're afraid it's going to stall. Look what's happening. 5.5, then we got 5.3, 4.8, 4.7, 4.3, 4.1, and then 4.0 for the October reading and 4.0 for the November reading. So this December reading that we're going to get in January is important. It needs to come in less than 4%. If it doesn't, then the Fed is going to start getting spooked that inflation is not continuing to trend lower. And that means that they're much less likely to start cutting rates, right? Because they want to see all of this taking an effect. So, really what I'm seeing right now is I think when we look at mortgage bonds, I think we're flattening out here. When we look at the 10-year Treasury yield, we're at 3.95. I think we're going to see this push back above 4. I don't think it's going to be in the 3s all of this week. I think it could definitely push back above 4. Right now, we have the 200-day moving average at 4.02. Arguably, this would be a support level that the 10-year shouldn't go higher than that, but I don't necessarily think that it will. I think we're enjoying some time right now below that 4.02 mark, but I believe we're going to go back up there. I believe that rates are a little bit better than they should be right now, and that's why my stance is the one that I've had. I'm looking to go ahead and lock. Let me pop this on the screen. Where's my lock advice? All right. So my lock advice is to go ahead and lock anything that's closing in the next 30 days, cautiously floating anything that's longer term. The reality is that rates will improve through 2024 in fits and starts, meaning they'll improve a little bit and then they'll worsen and then they'll improve a little bit. However, when we see all this happen, I think that right now in the near term, I think everything points to us seeing rates that are a little bit better than what we should be looking at. I think the 10-year Treasury yield is a little bit better than what it should be. I don't think that it belongs in the 3s yet. I don't think it's going to stay here. I think we're going to end up back in the 4s by the end of the week. So as far as what economic data we have this week to contribute to that, if we take a look here, let me go ahead and pull us up to the calendar. And then we'll pull this back here. Looking at the calendar, I don't care about McNee. There it is. Here's the calendar. So looking at the calendar, we've got builder housing market index, then AHP housing market index today. Doesn't have any effect on anything. We're going to have the Bank of Japan tomorrow. I'm not going to go deep on that one. Markets will be watching that a little bit. We got housing starts and permits heading further up. Again, not going to affect rates or pricing. China's rate decision here, not going to affect us much. We got consumer confidence, which is going to have more of an effect than existing home sales. We've got a 20-year bond auction. I don't worry about too much. We're going to get the last GDP number for that third quarter. We'll see where that comes in. We, of course, get initial jobless claims. Then we get our PCE data on Friday. But remember, this is ahead of the holiday. So, we'll see how much of an effect, if it looks like this is going to have much of an effect on here. So, but anyway, let's see what you guys have to say, because y'all are chatting and I love that. So, good morning, Megan, Tim Klyla, Allison, Foy. Ron Siegel said, what effect do you expect to see with shipping being slowed in the Red Sea? 30% of cargo goes through there. A lot of oil goes through there too. We'll have to see how that plays out. I read BP was pulling back on that this morning. A lot of others have as well. I don't know yet. I don't know. It depends on how demand is, and that's the bottom line. So if supply continues to be an issue, then that creates more of an inflationary position. However, if the demand also drops, it won't have as much of an effect. Bobby Searson, Nathan Einkorn, good morning. Also, Ron Siegel said, Mike, I agree with you. Dan Rawich's comments last night was that we are late based on history for the rate cuts. But you know what? That's always, we know that that's all lagging, Ron, and they're all, the Fed is very, very much afraid of what happened in the 70s during the Volcker era and having inflation continue to worsen. So if we don't see this core inflation trend lower, that reading that we get next month in January, I think the 11th, this is key. If it doesn't drop us below 4%, I think that's going to have a lot of impact. Tim said the week before Christmas to New Year is going to be slow and light trading, some more volatile swings in rates. Yep, I absolutely agree, Tim. We won't have it so much the beginning of the week here, but yeah, as we get closer to the end of the week, and then next week, of course, it'll be a ghost town. So, but yeah, that's kind of, I agree with you where we're going to see some of that. So again, my advice, it remains where it has been, to go ahead and lock everything up. Anything's closing in the next 30 days. We could argue as we're getting closer that we've got that December 11th. If you're closing a loan sometime with a closing date in January, late January, but again, that's over 30 days. If you're right at that 30 days mark, maybe you start, you're floating. But I just think that looking at where we're at, looking at where these rates are going, I just think that it is a good time to go ahead and consider locking things up. There's just more risk to floating than there is potential reward right now. Again, I feel like we got a Hail Mary from the Fed last week, especially after not getting labor data that was good, and not getting the inflation data that we wanted. So the other thing to talk about with Ron's comments about, I didn't listen to Dan's commentary from last night yet, Ron. I'll listen to it later. But as far as being late for rate cuts, the Fed members just don't think that that's where we're at right now. Like Goolsby touts inflation progress, still low unemployment. There's arguably that these are lagging indicators and that we should see more, but they're not going to be quick to drop rates. And right now markets are already pricing in that we're going to be dropping by March. I think that might be a bit premature. It's only one meeting between then and now, and that's the January meeting. So we'll see there. And Ron said, if the Cleveland Browns can get a Hail Mary, so can we. Absolutely, my friend. So, all right, y'all, I'm going to wrap it up. Well, thank you for joining me. Remember, I do this each and every day. I actually should. I've been kind of playing around with getting started earlier, but I got to throw this in the middle. Remember, you can sign up for our written lock advice emails, www.ratelockadvice.com. You can also sign up for our I got myself in the face. You can sign up for our text alerts, www.ratetextalerts.com. You can learn more about how we get you loans from Google and social media at www.originatorssuccess.com. And you can also sign up for text reminders. Use this cool QR code here if you want to get a daily text reminder. It looks like this. You can sign up for it. I'll also throw that in the chat widget for you here with the link. If you would like to sign up to receive the live text reminder that you can jump on that I'm going live, and it's got the links to make it easy for you for Facebook and YouTube, go ahead and go to hmmr.io/live-reminder or use that cool QR code. Somebody did use that QR code. I know the problem is when you're on your phone, it's too bad you can't click like a QR code and have it register because you got to use your phone like on the computer to see it, right? So it'll get there. But you can also use that link, hmmr.io/live-reminder, and that'll take you there. You can sign up and get reminded of when I go live each day. So, all right, my friends, that's it. I'll see you tomorrow morning, same bat time, same bat channel, and look forward to talking to you more then. I'll see you tomorrow. Take care, everybody. Bye-bye.